You know, investing seems so simple on the surface, doesn't it? Just buy low and sell high. So how come so many really smart people get it so wrong so often? Well, we're about to dive into a powerful idea from a classic investing guide that might just change the way you look at companies forever, and hopefully help you make much smarter decisions. So, our roadmap for this comes from Pat Dorsey's incredible book, The 5 Rules for Successful Stock Investing. It lays out this fantastic, common sense framework for analyzing businesses. And we're going to pull out one of its absolute biggest ideas, a concept that really separates the flashes in the pan from the companies built to last. First things first, the book gets one thing straight right away. Picking winning stocks is really, really hard. It's not a game. It's a minefield of potential mistakes that can trip up just about anyone, no matter how careful you think you're being. So, what are these traps we're talking about? It's a good question to ask, right? Because just knowing what they are is the first and maybe the most important step to actually avoiding them. Okay, so here are a few of the classics. You've got chasing the hot new thing, panic selling when everyone's freaking out, looking only at the earnings number. But we're going to zoom in on that last one. Fallen in love with a great product because it feels so right, but it is one of the easiest and, frankly, most expensive mistakes you can make. And that brings us to the perfect case study, the Palm Pilot. I'm sure some of you remember these things. They were game changers. An amazing device, millions of people had one, loved it. On paper, it looked like a slam dunk investment. But here's the lesson. A fantastic product does not automatically make for a fantastic business. And here's the proof. Despite how popular it was, Palm's stock price eventually collapsed by more than 98% from its peak. Just gone. Why? Because underneath that cool product, the business itself was a mess. Razor-thin profit margins and brutal, non-stop competition. It's the perfect reminder that you have to look past the shiny object and analyze the actual business. And that is the perfect lead-in to the secret weapon that Dorsey talks about all through the book, the economic moat. This right here, this is the key to finding those truly great companies that can stand the test of time. So what in the world is an economic moat? Well, think of a company like a castle. And the profits? That's the treasure inside. The moat is the big, wide, deep ditch around the castle that keeps all the invaders, in this case, the competition, from coming in and stealing the treasure. It's a durable, long-term competitive advantage. This slide just nails the difference. Look on the left, a company making memory chips. It's a commodity. The only thing that matters is price, so competition is fierce and profits are all over the place. Now look on the right, Tiffany. Sure, they sell jewelry, but what are you really buying? You're buying the brand, that little blue box. And that brand power lets them charge way more and earn steady, consistent profits. That brand is their moat. But here's a crucial point. Not all moats are the same. You've got to think about them in 2 ways. First, there's depth. That's how profitable the company is. Can they make a ton of money? Then there's width. That's how long they can keep the competition away. You might see a tech company with a super deep but really narrow moat. They make insane profits for a few years, and then, poof, it's gone. The trick is finding moats that are both deep and wide. Okay, so if these moats are so critical, how does a company actually build one? Well, Dorsey says they really come from a handful of very specific sources of power. He basically boils it all down to these 4 main types of economic moats. When you're looking at a company, these are the big 4 you want to be hunting for. So, first up, we have intangible assets. This is stuff you can't touch, like patents or government licenses, but the big one is usually a powerful brand. Just like we saw with Tiffany, a great brand makes people willing to pay more for a product that might be functionally identical to a cheaper one. That's pure profit, created out of thin air. Second, there's a good old-fashioned cost advantage. This one's simple, but it is so powerful. If you can make or deliver your product or service for less than anyone else, you have 2 amazing options. You can either lower your price to grab more market share, or you can sell at the same price as everyone else and just enjoy much bigger profit margins. And this is just a brilliant example. Back in its heyday, Dell's whole direct-to-consumer model was revolutionary. Look at their operating costs. Just under 9% of revenue. HP, on the other hand, was at 16%. That massive gap was a huge cost advantage that let Dell run the PC world for a long time. Of course, it's also a good reminder that moats aren't always permanent. Eventually, competitors caught on and that advantage narrowed. The third kind of moat is creating high switching costs. This one's a little more subtle. It's when it is just such a massive pain in the neck for a customer to leave you for a competitor. I mean, think about moving all your money from one bank to another or retraining your entire office on a new piece of software. That friction, that hassle, that is the moat. Customers are effectively locked in. And finally, we have the network effect. This might be the most powerful moat of all. It's when a service gets more valuable to every user as more people join. eBay is the perfect example. Buyers go there because that's where all the sellers are, and sellers go there because that's where all the buyers are. It creates this incredible feedback loop that makes it almost impossible for a newcomer to compete. Okay, so you did your homework, you found a company, and it's got a wide, deep moat. Fantastic. But hold on, you are not done yet. A great company can still be a terrible investment if you don't check for a few other critical red flags. First up, you have to look at cash flow, not just earnings. The book puts it perfectly. Earnings are an opinion, but cash is a fact. You can play all sorts of games with accounting to make earnings look good, but cash flow, the actual money coming into and going out of the business, that is much, much harder to fake. Cash is what pays the bills. And that leads to a really fundamental question about the people running the show. Are they working for you, the shareholder, or are they just working to enrich themselves? So you want to be on the lookout for these kinds of warning signs. Things like insane pay packages and perks, bonuses that have nothing to do with how the company actually performs, or executives who are constantly dumping their own stock. What you really want is what they call skin in the game. You want to see managers who own a ton of the company's stock themselves. That way, their interests are the same as yours. They win when you win. So we've covered moats, cash flow, management. These are all incredibly powerful tools. But none of them mean a thing if you don't follow the book's single most important ultimate rule. And it's this, right from the founder of Morningstar himself. You have to have the courage to think for yourself. Forget the noise, forget what the experts on TV are shouting about, do your own homework, trust your own analysis, and stick to your guns. At the end of the day, this whole idea of an economic moat isn't just a simple checklist. It's a completely new lens to see the business world through. It's an incredibly powerful tool, but it's up to you to actually pick it up and use it. So I'll leave you with this question. Now that you know what to look for, what company, right under your nose, has a moat you've been completely overlooking?